Today we continue our discussion on journalizing, and this is where we left last time. The transaction was about the purchase of equipment. So we continue to the next transaction, and that is on January 5. On January 5, the company applied a loan of 200,000 from Generous Bank and was approved and given the amount loaned on the same day. So of course, like what we did in the prior transactions, we will start with identifying the analytical part. And analyzing the transaction above, we would know that the accounts affected are number 1, cash. Cash is affected because once the loan is granted, it is obvious that the bank who grants the loan will be giving cash or a certain amount of cash based on the loan contract to the creditor, to the debtor. So obviously, the company here will receive 200,000 cash from Generous Bank. So that is the first account affected, cash. And again, we knew that cash is an asset account. Okay? So the next one is loans payable. So the loan itself that was granted will represent a liability on the part of the company, because obviously this loan will be paid, and being a liability, and the liability as to nature emanates from a loan, it would be more representative if we use the account title loans payable. But again, we have to be reminded all the time that we have to base our account title to use in the chart of accounts. And just to show you again what we had in the chart of accounts, this exact copy of the chart of accounts I copied to a separate file. We have here the liabilities, and one of them, as you can see, is this one with a code of 19, and that is loans payable. So that's the reason why we are able to use the account title loans payable. So we continue. So again, from identifying, we were able to determine that the two accounts affected are 1, cash, which is an asset account, and 2, loans payable, which is a liability account. Therefore, since this transaction has an effect on the elements, asset, liabilities, as the elements affected, we will be able to conclude that this event is an accountable event. So now we go to our further analysis. What transpires here? So before the transaction, the assets, liabilities, and owner's equity already have their respective balances because we already have prior transactions, right? So the assets, liabilities, and owner's equity have their respective balances. But obviously, these balances don't have the effects yet of the transaction. So those balances did not have the inclusion of this transaction on loans and the cash that was received. So obviously, after the transaction took place, now we go to the analysis of what happened after that. Cash with a prior balance, because again there were already prior transactions. So cash with a prior balance is now increased by 200,000. Increased because we received cash. So the company, sample services company, received cash. For that reason, obviously that cash is increased by 200,000. And that also, being an asset account, that would also have an effect of increasing the total assets by the same amount. So now we go to the other part of the transaction, and that is about loans payable. So the loans payable previously has zero balance because there were no loans previously. as we remember all the prior transactions. So loans payable has none so far before this transaction, and obviously after the transaction was consummated, there becomes now a loans payable of 200,000 because you now assume a liability. Having received cash that is to be repaid in the future, obviously, will make you liable to repay such amount, and therefore again, as I have already explained previously, there will be recognition of loans payable account, which is a liability, and therefore there is an increase in the loans payable from 0 previously to 200,000. So of course, being a liability, the effect is it will also increase total liabilities by the same amount. So illustrating it on the table, this is what happened. The company, because of the loan, was able to increase cash because it received cash. But at the same time, because it has to pay that cash, it will recognize loans payable. And from 0 loans payable, the loans payable now has a balance or an amount, and that is 200,000. So that is why we have an increase also in the liabilities of 200,000. So let me reiterate. Because of the transaction, assets increase by 200, and that is from cash. Liabilities, on the other hand, increased also by the same amount, 200, and that is because of loans payable. The transaction did not affect any owner's equity account. That is why it is 0 on this part as to effect. So that is how the transaction affected the accounting equation, and as you can see, the equality here is always maintained. 200,000 on the asset side is equal to 200,000 plus 0 on the liabilities and owner's equity side. So again, as I have said and already explained previously, the equality of the total debits and credits must be maintained at all times. So now we observe the effects of transaction. Again, the asset cash with a prior balance, just reiterated actually, is increased by 200,000, and from zero, the liability, which is entitled loans payable, is increased to 200,000. So we have this as our effects of the transaction. Cash and asset increased by 200, and loans payable and total liability increased by the same amount. So now we go to our transaction analysis for journal entry. So now again applying the rules on normal balance. Remember again that when we increase an asset, we need to debit the asset, and therefore cash, because cash increased here and cash is an asset account, therefore we again debit cash for 200,000. And liability in this case also increased. Again, the liability we are talking about is this one, the loans payable. And since the liability increased, remember the rules on normal balance. When we increase a liability, we should credit the liability. That is why loans payable should be credited for 200,000. So after the transaction analysis, now we can go to the journalizing part, the bookkeeping, the procedural part. From the transaction analysis, again, just reiterated, cash should be debited for 200, loans payable should be credited for 200 from this part. So after this, we may now construct the journal entry. So as you can see, we simply do what we came up in the transaction analysis. So cash, we debited it, and the amount 200,000. The other part, we credited loan, this one, and the amount also 200,000. So like what we do also in the previous transactions, we also have to put the explanation of the transaction, and since it is a bank loan, then our explanation can be as simple as bank loan. Okay, so that is transaction on January 5.